Whether you trade stocks, ETFs or currencies, every trader needs a plan. That tells you when to enter and exit a trade to make a profit. Welcome to the third of a 4-part series to show you how to use Theta 45 to create a trading plan. In this episode, we'll look at how to use Theta 45 to backtest your trading plan. In the last 2 episodes, we used Theta 45's signal risk screen to determine our buy score, and then used the odds screen to convert the buy score into an actual buy price. But how can you as a trader be confident that this price is low enough to buy so that you can sell at a higher price, either that same trading day or by the end of the next trading day? You can use the volatility or the backtest screen to verify if the same strategy would have worked in the previous 64 trading days. Let's assume we use a simple passive trading strategy where we buy at a buy score of 75 for each trading day where the buy score hits 75 and above. The signal risk screen identifies how many trading days out of the last 64 when the buy score was 75 or more. The volatility screen allows you to identify at a glance on which days the buy score hit 75 or above. In the volatility chart, the buy score hit 75 or above on all the days where the volatility was -1 or below. You can zoom into this chart to see that the price was in a higher band either that day or the next when the buy score was 75 or when the volatility was -1 and below. Go to the backtest screen on these dates to find out what price you could have bought and sold to make a profit. Using the simple passive trading strategy, we buy when the price hits a buy score of 75. What we're looking for is a higher sell price, either that trading day or by the end of the next, for each date identified. In our third day, we get a loss when buying at a score of 75. This is because the general predicted trend in the market was downward. To mitigate the risk of not having a higher price to sell, you should select a higher buy score. Or employ an active trading strategy and buy towards the bottom. As we cycle through the remaining days, using this strategy we break even on day 11. But then continue to be profitable for the remaining of the trading days when the buy score was 75 or above, giving this passive trading strategy a success rate of 87%. Instead of deploying all your capital when the buy score hits 75, you can use a staggered passive strategy. For example, you can deploy half of your capital if the buy score hits 75 and the remaining half if the buy score hits 87.5. Or split your capital into thirds and wait for the buy score to hit 100 before investing your final third. Alternatively, instead of dividing your capital equally for each band, you can weigh them and buy proportionately more shares as the price drops lower. While Theta 45's technical analysis alone can make you profitable as a day trader, you still need to know what information drives the price up or down for each trading day. In the next episode, we look at the information that will drive the price of a stock in the short term. Remember to subscribe so you don't miss the next episode, and smash that like button if you found this episode helpful.